tutorial, I'll be going through with you Robert Half stock. Just type it in Google and paste enter, and you will see the name here. And you can see the stock symbol RHI, the Nasdaq symbol, and it is 55.84 US dollars for one stock. And it's a billion size firm, so it's a big size firm. It pays dividend yield. Don't be worried by the dividend yield that it's very less. Maybe some of you might think that it's very less, but I just want to point out that companies that are paying dividend, even if it's less than 1%, that's a positive news, because that means they're financially strong. Because after paying their creditors, loans, liabilities, costs, they still have extra money. That extra money they pay to shareholders as dividends. So it's a very positive news. And let's go to Wikipedia and see when was this founded. I can see it's 1948, and I want to see what the employees think about this firm who work here. So what I'll do is I'll copy this exactly from Google, and just one second, copy, and I'll paste it here. Type Indeed reviews and see what employees have to say about this firm. And I can see we have 7,700 reviews and it's 3.9 star, which is brilliant. Go through the pros and cons yourself, what people have to say who work here. Check out the salaries, the photos of the firm, the jobs listed, and the questions asked. Check this firm in Glassdoor as well, because that's very important website for reviews of employees. And I'll just click here now, and I can see we have 6,700 reviews and it's 4.3 star. Read the pros and cons yourself. Check out the jobs listed, the salaries they're paying, the interview questions, the benefits they're getting, and the photos. Now let's check in Justia patents. And I just want to see that what patent this firm has. Just copy, like paste it here exactly. And I just want to point out that please look at applicant or assignee, because these are this person has the full rights of the patent, so that's important. So I can see in 2001 they have patent, and this is a different firm altogether. This is not the one we are looking at, and this is a different firm altogether, so that's not what we are looking at. So I'll skip that. So make sure that the name matches with the one that you're searching, so you can just go through yourself and see if it has any patent. I think it only has one patent in 2001, but there's a lot of list, so you can just have a look yourself. No, I don't think it has any more patent, maybe, but there's a big list, like there's another page to it as well, so you can just scroll down and see it yourself. It's a big list. But no matter what, even if it has one patent, that's important, because that means they're strong. Any firm that has patent, that means they're strong. They have a moat and it's difficult to beat them. But I need to know that why they don't have any recent patents in 2015, 16, 17, because if it has any recent patents, that means they're still innovating, but they have very old patent in 2001. So that's something to think about. And let's go to Yahoo Finance, and I want to check out the key executive salaries, because that's very important for me to know. So I can see, please match the symbol of Nasdaq. So click on RHI, which is symbol of Nasdaq. Go to profile, and you can see the sector, industry, and employees. And the best part is that the key executives' salaries have been shown. So they have shown us all the salaries of key executives. It builds trust, because it's very transparent, because we know all the salaries key executives are getting. That's brilliant. Let's go to macro trend, and I want to see the ratios. So go to price ratio, price book ratio, type in the symbol, click there, and I just want to explain you briefly. Price book ratio, if it's less than 1, that means stock is safe. Sorry, if the price book ratio is less than 1, that means stock is cheap, it's undervalued, and it's a sale if it's less than 1. If price book ratio is more than 1, that means the stock is expensive. The higher the number goes, the more expensive it will get. So it's just loading right now, and we'll see that. And please bear in mind that this website has a lot of data, so it will take time to load. Be patient with it. And so let's see. Okay, I can see here that it's 5.93 right now, which means that the stock, if somebody buys stock right now, they will be paying 5.9 times more money to buy the stock. It's expensive. If somebody bought stock in March 2019, they paid 7.16 times more money. So they bought it for 65, they paid $65 for something that was $9 worth. So it was 7 times more expensive they bought in 2019 March. Right now it's 5.9 times, nearly 6 times more expensive. In I would say in 2009 it was 2.33 times expensive. So somebody who bought in 2009 March, they paid $14 to buy something that was $6 worth. And in 2015 March, it's 7.7 times expensive. Somebody who bought that time, they paid $56 to buy something that was $7 worth. Right now, it's 5.9 times, nearly 6 times expensive. So it's up to you to decide when you want to buy. You want to wait for the price ratio to come down, or you want to buy right now. Let's go to other ratios and I'll show you current ratio. If current ratio is less than 1, that means stock is risky because liabilities are more than assets. If current ratio is 1.5 or more than that, that means stock is safe and it has good margin of safety. So please look for 1.5 or more than that for it to be ideal. So let's have a look. Okay, right now I can see it's 1.7. It's more than 1.5, which means stock is very safe. That's brilliant. Let's look at the previous trend. Has it ever been below 1.5? That's my question. Okay, so we have data since 2005 up till now. Since recent 14 years, consistently the stock has been more than 1.5, which is brilliant, which means stock has a very good margin of safety and it's a safe stock consistently for recent 14 years. It has always been above 1.5, so it's a very safe stock consistently. That's brilliant. Let's look at debt equity ratio. This ratio will tell me if the company is mainly operating on debt or equity. I'm looking for zero point 0.5 or less than that for it to be brilliant and safe. So let's have a look. So it's just loading right now. Let's wait. Okay, right now it's I can see it's less than zero point 0.5. That's brilliant. So it's a very safe stock in terms of debt. So that's brilliant. Even though the firm has debt, but still it's below zero point 0.5. That's brilliant. And I can see that the consistency of it being below than zero point 0.5 since 2005 up till now, it's always been below zero point 0.5. That's brilliant. So it means the company is safe, very safe in terms of long-term debt, and which is very very positive news. There's a lot of margin of safety. Now I'm looking for return on equity. I'm looking for 8% or more than that for it to be brilliant. Let's have a look. Okay, right now I can see that it's more than 8%. That's brilliant. Um, so it's brilliant. Let's look at the previous trend. Has it ever been below 8%? That's my question. Yes, it has been below 8% in 2009 and 10. And then, you know, consistently I can see from 2005 up till now, it has always been above 8%, except 2 years in 2009 and 10, which is okay because at least it's a positive equity return on equity, which is brilliant. But I'm looking for 8%. It is below 8%, but once off it's fine. For 1 or 2 years it's fine. In like, if I see, I have data since recent 14 years, and in 14 years, if for 2 years it is below 8%, that's fine. But at least it is a positive return on equities, that's fine. So I would say that overall it's doing very good in terms of return on equity.